The Bank of Canada has another print to digest before next week's announcement on interest rate policy. Canada's November retail sales rose 1.3%, although it looks as though December saw a downturn. That's according to early estimates. Let's get more from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, always great to see you. What is, if you could generalize, what is the picture for the Canadian consumer right now? We know that confidence is not that high.
That's true. But first of all, good morning, Andy. Pleasure to be here as always. For the Canadian consumer, well, let's start with the number and the retail sales. It basically beat expectations, came in largely as expectations, but beat it in regards to the headline number, especially on the core. So when you take out autos and stuff, 1.7 versus 1 expected looks good from a headline perspective, but there's a lot of noise in that number, especially from BC strikes and, beverages and beer sales were actually the driver of that. So you have to discount the number a bit, which points to the advanced number for next month, which is minus 0.5. So it's pointing to a weaker consumer, which isn't surprising in this environment, given the uncertainty, global uncertainty, economic uncertainty. So it does point to a weaker consumer going forward for the balance of the year.
And does that is that a big deal for the Bank of Canada as they assess interest rates, consumer behavior, or what are the crucial metrics they look at? Labor, obviously,
it's an important metric, but so let's stick with this. Does it impact them right now? No, we believe the Bank of Canada will be on hold next week. This number doesn't change anything. And remember, the advanced number is an advanced number. It's an indication and could change towards as we get to the real number. So your other question, what are the important metrics for the Bank of Canada? There's two important metrics in what I'd call top tier. The first one's inflation. And inflation still remains sticky. It's still above their target band of, let's call it midpoint of 2%. So that's an important consideration. And one of the reasons why they'll remain on hold, especially when you look at the actual cost of goods, you look at commodities, you look at all the things that will impact inflation in the future, and they don't look like it's going down. The only thing that's negative from an inflationary perspective are rents. But again, the influence of that on the overall inflation number is limited. The second most important number that they look at is employment. And they look at employment because that reflects the consumer's ability to spend, whether it be on mortgages, rent, and most especially goods, consumer goods. And as you've seen, we've been getting surprisingly strong numbers on unemployment. The unemployment rate's still fairly elevated, but it's not as elevated as the market was expected. So again, another reason to be on hold. Our team's, longer term outlook, we do expect eases this year. We expect between 1 and 2 eases by the end of the year. And that's still driven by the uncertainty surrounding USMCA, the lack of business investment because of that uncertainty. We feel that'll have a drag or negative impact on Canadian growth.
The interesting thing, obviously, is what point does Bank of Canada rate policy become aggressively stimulative for the economy? If they do cut it again, is it fair to say that they're trying to rev up the economy?
Yes. So that brings in the third most important number, which is growth and GDP. And right now, growth is positive. So when do they become extra stimulative? They would argue they're kind of neutral to stimulative now, minorly. But when do they become more so stimulative? If growth really takes a downturn. And that's why I point to the first tier numbers. Employment's usually a leading indicator of growth. Less people employed, there's less production, and it's a leading indicator of consumer spending and the ability to afford rent. So until you see growth come down in those other two numbers, they're all right to be on hold. The reason why we believe there'll be an ease towards the end of the year, that extended uncertainty from USMCA, you might need a little extra boost in the economy. And although interest rates won't have a dramatic impact, especially it's only 1 or 2 basis point eases, it does in fact impact the psyche of the consumer. And that's a very important aspect as well. And I'll bring up one more thing that the Bank of Canada pays a lot of attention to, and that's the business survey. Business survey outlook just came out last week, and that points to what business owners are looking to do going forward. And that's where that uncertainty around USMCA is being reflected. So if you see a downturn in that, further downturn in that, that will accelerate the stimulation that the Bank of Canada will put into the market through interest rates.
Obviously, 10-year bond yields in Canada, for example, are a powerful driver of mortgages and the cost of businesses borrowing. That yield has been pretty flat for more than a year ago. No big swings.
Yeah, it's been surprisingly flat. And part of the reason for that is one of the largest influences on the 10-year rate that you're showing now is actually the U.S. 10-year rate. And ever since Bessett in the U.S. has said, you know what, the Treasury's there to support yields if we need to, as well as the tariff income has reduced the amount of issuance in 10-year bonds in the U.S., so that has kept 10-year bonds relatively flat for the past year. And that's actually one of our underlying sort of investment premises. We believe 10-year yields will be within the range of the 2025 yield. And we're right at the midpoint right now, or just below it. So there's nothing to do on interest rates in regards to sovereign bonds, 10-year bonds right now. But if we do get a spike higher in yields, like it looked like we could have earlier this week before President Trump backed down from more aggression towards Greenland, then we become better buyers. The good thing about stable 10-year rates, it makes investing in corporate bonds increasingly important. And the reason why it makes that increasingly important is because you want a stable coupon yield. And that's what you get from corporate bonds. You get that 10-year rate that you saw, the 343 in Canada, or 425 in the US, and you add in the corporate spread, and you get even more interest, and it's above inflation, which is why we are overweight corporate bonds and like buying corporate bonds on any sort of volatility or backup. It's almost the equivalent reflection of equity markets in a sense.
Earl, thank you very much for joining us. Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management.